Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by returning guest Gary Savage, president of the Smart Money Tracker. Gary, how are you doing this morning?
I'm doing pretty good, Robert. Thanks for having me on.
Really looking forward to this. We have plenty to talk about since we last spoke in January. And just for time stamping, we're recording this in the morning of Tuesday, the 23rd of September. The reason I say that is the market's quite buoyant at the moment. But you were just saying to me off air that both gold and silver, by the looks of it, have broken out of some large cup and handle patterns. So, what are we looking at the moment? What's going on, Gary?
So the what I was referring to there was the cup and handle pattern, 13-year basing pattern in gold that broke out last year, March, I guess it was, when the shorts couldn't get gold back below 2000. I said at the time that I thought the suppression of the gold market had broke, and it clearly has. We've had this very aggressive short squeeze rally that's getting close to doubling. We're closing in on 4,000. I think we're going to get to 4,000 here. Oh, probably by the end of October, maybe mid-November. But we've also just broken out of a 4-month consolidation. You get a leg up in the market, and then you'll either get a correction, or what has happened in gold over the last year and a half is, instead of a normal ABC correction, we're getting these sideways churns, and I think that's just um, a factor of the short squeeze that's in play. Is the shorts are just losing billions of dollars, and so they're having to cover on any pullback, and so we're not getting the normal ABC correction. We're just the shorts are panicked and covering prematurely. So instead of a deep correction, we're getting a sideways churn that kind of accomplishes the same thing. It builds the fuel for the next rally, but it does it by creating frustration rather than fear. And we just went through one of those from April till recently, when gold finally broke out of that sideways consolidation, has started the next leg up, and I think silver's on its way to 50 probably during this particular intermediate rally. And once it's done, maybe the next correction is going to be more of a scary um, kind of an ABC move, something that gets a little bit closer down to that 200-day moving average. And there's a couple of reasons why I think that may happen.
I know that when we spoke in January, I think we went with the headline along the lines of 7,000 gold and $50 silver will be a piece of cake. Things have changed a lot between January in terms of pricing, but in terms of the that gold target, $7,000, that's still what you're looking for, or has that changed in the last 6 or 7 months?
Oh, I think 7,000 is probably too low. I think pretty sure we're going to get to 10,000. I mean, that's just a little over a double from here. And we're clearly not into the final parabolic, bubble phase of the bull market. Silver hasn't even broken out above 50 yet. So I think it's probably um, too modest of a prediction to say that this bull market is going to stop at 7,000, which isn't even, it's not even a double from here. The bubble phase can easily double in a year or less. Gold and silver, especially silver, is a pretty thin market, so it's much easier for gold market to double than, say, the S&P.
Mhm.
And so I think 7,000 is probably too mild. I would say 10,000 is probably more realistic. And yeah, I may have to ratchet that estimate up as well. We may get to 15 or even 20,000 during that final manic buying spree. And for silver, I've been on record for years saying $100 silver is going to be a piece of cake. Again, that's probably way too low of an estimate, because $100 silver is only a double from 50, and we're looking at a 40-year base. There's just no way a 40-year base is only going to produce a double in silver above the all-time high. So I think $250 silver is more realistic. And I think there's a pretty good chance we could get to 500 during that final parabolic move.
Certainly numbers I think people are gonna like to like to hear, $500 silver being possible. In terms of the fundamentals, and the reason I ask this, 'cause I know you've spoken about this for years, but I'm aware that sometimes more and more people get into the gold and silver space, and they might not know the basics of why this is happening in these markets. So in terms of, financial issues, whatever it might be. So if you can, just for people that might not be aware, why are we seeing what we're seeing in gold and silver at the moment? What is it a culmination of?
So exactly right. There's a combination of fundamental drivers. One is that the government just prints a lot of money. Um, the, that liquidity's got to land on something. It's been landing in the stock market for the most part since about 2011, 2013 maybe was when we had the big breakout. Um, but at some point, the stock market gets overvalued and the liquidity starts to leak into the commodity markets, and then you get a shift from well, I'll say usually this happens. You'll get a shift, and stocks will start a secular bear market, and that liquidity will move into the commodity markets, and you'll get a secular bull market in commodities. But I think we're in a bit of a strange period where the liquidity is flowing into everything right now. I think the stock market has further to go. I don't buy into this concept that it's, there's an everything bubble. There probably will be, but I don't think we're there right now. I'm not seeing signs of a bubble. The stock market's not, the S&P is not 60% above its 200-day moving average. I'm not seeing every Tom, Dick, and Harry bragging about how much money they're making day trading the stock market, or AI stocks in particular. AI is still mostly in its infancy. You don't really get the crazy, insane overvaluations until the industry gets at least somewhat mature. Um, so I think stock market has further to go, and I think the gold market particularly has a lot further to go. So that's one driver is monetary inflation.
Mm.
Also, when we ignited the inflation cycle back in when we closed down the world for COVID, stupid policy. But that also was going to ignite the war cycle, which it did. And I think I'm pretty sure the war cycle is going to accelerate and get worse, not better. So that's another factor involved in driving gold higher is the war cycle is going to get worse, and gold is a safe haven in times of war. And then another big factor I think that's probably gonna be what drives gold possibly beyond 10,000, maybe a long ways beyond 10,000, is that it's the metals market has been suppressed for literally for decades, and we're seeing the result of that suppression breaking. And I think if the metals market had been allowed to just trade freely, I think a realistic target was probably 8,000 for this bull market. But because it has been suppressed for so long and it's created deficits in the silver market for the last 5 years, um, I think that is going to drive the market, the bull market, much higher than it would have gone if it had just been allowed to trade naturally. So that's why I say 10,000 is probably a more realistic target, and might even get to 15 or 20,000, $500 on silver.
Well, thanks for going through that. So I appreciate that sometimes people just can look at the charts and look at it go up and not understand why that's happening. So thank you for doing that. In terms of war cycles, yes, I won't get on my political high horse about that being from the UK, but I agree with you. I think it's going to get much worse before it gets better. And I appreciate that in the USA, you've had your own political challenges in the last few years as well. But enough said on that. Just going back to suppression, though, and again, we could link this to gold and silver because I know you posted this on X on, I think it was 3 or 4 days ago, like 19th of September, I think. And you mentioned about the suppression in the silver market, and you on your post said that the last major resistance is a little over $44. After that, it should be a clear run to 50. I mean, we're recording this and silver, I've got it down at just over $44. So let's switch over to silver. Once that resistance gone, 50 is going to be the massive psychological barrier as well, isn't it? 'Cause that's the nominal high from 1980.
So, on the December contract anyway, silver is above that resistance zone, and that's what I trade off. I trade off the active month contract, and that's where the trading is occurring. So it is above that resistance level. If it holds it into the close, then it will have pierced that level, with no pullback at all, just on the first day, sliced through it. The miners kind of did the same thing. They had a major resistance level at the all-time highs in GDX. They sliced right through it first day, came back down to test it, and then took off again. So I my ongoing theory is that the dollar's most likely going to bottom on the October FOMC meeting. That would be the likely trigger event for the dollar to form an intermediate bottom, get a bounce. I'm pretty sure the dollar's in a secular bear market, so it would be a counter trend bounce, not something that's going to go a long ways. We're not going back to 114 or whatever it was. Kind of doubt we'd even go back above 100, but that would be the opportunity, I think, for gold and silver to give us a top and either churn sideways again for multiple months. Although at this point it's so far above the 200-day moving average and the 200-week moving average that it would probably have to churn for 8 months to a year, and I don't think that's likely.
Mhm.
I think that would waste too much of this 8-year cycle. I'm of the opinion that we're going to get our final bull market top in gold during this 8-year cycle. We're about 4 months into this cycle, or 4 years into this cycle. So I don't think we have time for gold to waste 8 months or a year going sideways. So that's why I'm of the opinion, we'll see here sometime early next year whether I'm correct or not. But I'm of the opinion that everybody has gotten used to these sideways churns in gold, and they're going to expect that to happen again. So they're not going to be too worried about a big percentage pullback in gold. And so I think probably the most likely form of the next intermediate correction will be a scary pullback. And one of the reasons I also think so is that the average retail trader is starting to pay attention to the metals market now. Once we go above $4,000, you're going to get a lot of, unsophisticated retail traders FOMOing in close to the top. And I think we've got to probably knock those people off and scare them in order to create the fuel for the next leg up, which could easily produce a 100% move. So let's say if we get to, I don't know, 4,100 to 4,300, and then we drop back down to maybe 36, 3,700. Anybody that bought at 4,000 or above is going to, they're going to panic and sell at the bottom there. And that's going to create the fuel for the next run, which I think could take us to maybe close to $8,000 on that next intermediate run. So that's my opinion. I think the next intermediate correction, when it comes, is probably going to be more of that typical ABC, really scary type correction that convinces everyone that the bull market is over, and that I'm never going to buy metals again. And that creates the fuel for the next move. So we'll see if I'm right or not. Maybe I'll be wrong and we get another one of these sideways turns, but I don't think so. I think it's going to be more of a scary correction next time.
Well, I will. I'll put a link to your X channel on the post that comes with it, because I have to say, following you for about a year or so, you've been remarkably accurate with some of the things that you've said. So I will suggest people have a follow of you on X as well. Just so I've got this clear in my head, Gary. So you're saying that in your opinion, we've got an 8-year cycle, 8-year bull market and so forth, but we're in year 4. So in effect, the date as far as you're concerned, or the year that people really should be looking for is 2029, and maybe the back end of 2029. And then in the short term, you're saying that we could in gold get up to 4,000, but then we might see an ABC correction, flush out the weak hands as such, and that's just a setup for a potential move up there to $8,000.
Correct. Yeah. Um, I think this intermediate cycle has further to go. I think
Mhm.
it's going to get to probably $50. Silver could go above $50, just like the miners went right above those, sliced right through those all-time highs. Gold, I think, is probably going to 4,000. I also think it's likely to go above that, especially if gold were to get to 4,000, say in early October. Well, I don't think the dollar is going to bottom until at least the FOMC meeting. So that still leaves potentially 3 more weeks, 2 or 3 more weeks for gold to rally before the dollar bottoms. And I doubt that gold's going to top until the dollar bottoms. So if we get to 4,000 fairly early, or we get to $50 silver fairly early, with still several weeks to go before the FOMC meeting where they're going to cut another 25 basis points,
Mhm.
then that opens the door for going through those two resistance zones and the top coming somewhere above that. And that would there's going to be a lot of buyers that are going to assume that a breakout above 50 means a sustained move, or a breakout above 4,000 means a sustained move. And so they pile in on that breakout, but a breakout that comes kind of late in the intermediate cycle, or a breakout that comes, you know, close to a trigger event that could um, cause the dollar to rally for 6, 8, 10 weeks, is not generally a great place to be buying. It's probably a better place to take profits. So that's kind of my feelings. Is we still got ways to go in this rally, and but once this rally's over, we'll have some kind of correction, probably an ABC move, but then much higher prices in the next 2 or 3 years.
How important psychologically is that $50 nominal high in silver? Because I've been seeing other people say similar things where they wouldn't be surprised if it got to that level or got to just above that, and then we see more how should we put it, shenanigans in the market. What's your opinion on that, Gary?
Well, clearly the suppression of the gold market broke last year when they couldn't drive it below 2,000. It's also clearly broken in the mining stocks. Now, I was of the opinion it was going to break in silver first and then the mining stocks, but I got that one wrong. It broke in the mining stocks next, and I'm pretty sure it's in the process of breaking in the silver market right now. So I don't think there's going to be too many shenanigans. The banking cartels just lost too many billions uh, on on gold, on the mining stocks, and now they're losing it in silver. I mean, are they really going to be stupid enough to keep trying this at
Yeah.
$50? And then if it goes through 50, just more billions of dollars down the drain. At some point, you got to quit throwing money down the endless pit. So I doubt that there's going to be too many more shenanigans in the silver market. So again, if we get to 50 pretty quickly, then I think we could go through it. One of the things to look for to suggest that we are approaching an intermediate top is you'll start to get some crazy upside days in silver. 5, 7, maybe even a 10% upside day in silver. When you see that, that's that final. The sentiment has just gotten wildly bullish, and the retail traders are piling in, assuming that they've found the pot of gold at the end of the rainbow, and they're gonna they're making plans to buy their next Lamborghini or their next island or whatever, and so that is a red flag that you need to be selling to those people and getting on the sidelines with your trading positions. Now, I would never sell my physical gold or silver. I ride out intermediate corrections, and I have been riding out intermediate corrections in gold and silver since 2016. But for trading positions, especially like us, we tend to leverage a little bit whenever I think we have an intermediate bottom. and we hold that leverage until we get to an intermediate top. So when silver starts to get crazy, crazy big gains, you know, like I said, 4% days, 5% days, 7, 10% days, that's an indication that you're just about at an intermediate top and you need to be, the last chair and musical chairs is about to get pulled away and you need to grab the chair before you get caught.
Thank you for making the distinction between trading and holding physical, because I do think that that's something that a few people can get confused about. Because I know that if people are looking at the price at the moment, let's just call it $44 for argument's sake, people will ask, well, is it too late to buy physical silver, or should I trade with leverage, etc., etc. I'm not asking anyone to offer financial advice. This is not financial advice from me or you at all. What would you say to people that do look at that $44 mark and are considering buying physical? Is it just a case of, well, maybe dollar cost average in? What would do people need to look for?
Well, if you're like me and you think $100 silver is a piece of cake, then how could $44 be too late to buy? If you think $250 is likely, um, and maybe even $500, how in the world can $44 be too late to buy? The only reason that you could have for not pulling the trigger at $44 is that you're worried that you might have to suffer a drawdown. And in a trading portfolio, especially with leverage, yeah, you don't want to suffer a drawdown on leverage. So um, that might be the case with a trading portfolio. Although again, I think we're probably going to go to 50 during this intermediate rally. But for physical gold and silver, you're not going to panic sell during an intermediate correction. I mean, we all weathered the 8-year cycle low in 2022 on our physical gold and silver. I never thought twice about it. And I don't think anybody will. So, intermediate corrections are non-events in your physical gold and silver. You're not gonna panic sell at the bottom. You'll hold right through them, and it won't even occur to you to even get your calculator out and figure out what the price of your or the worth of your physical gold and silver is at that time. You're more likely to buy more of it if it's physical gold and silver. But for trading portfolios, yeah, you you know you could probably still buy right now because, like I said, I think silver and gold still have probably to the FOMC meeting in October before they're going to top. So likely target's $50 silver, still got $6 to go.
Mm.
Likely target in gold is at least 4,000 and probably 4,100 to 4,300. So you still got plenty of profit, tradable profit there. But again, once we start seeing silver do some crazy stuff to the upside, you need to start thinking about taking profits.
I'd also add to that it's important to figure out or have your own thesis as well. And I know you've mentioned some price targets there, and you alluded to it very well, that if you think that gold is going to X price, or you think that silver is going to go to X price, all you've got to do is look at what it is today and then realize that there is a lot of room to run, especially if you're looking to add to the physical or start a physical stack. Gary, I know you mentioned about why gold's moving, and you mentioned the fundamentals, and you've also mentioned that there is a deficit in physical silver as well. How big a part does the industrial usage of silver play? Because it seems to me that that's more important at the moment than people actually remembering that silver is indeed a monetary metal. I don't know if you have any thoughts on that at all.
I definitely think the demand for silver is only going to increase over time. It's a integral part of, well, all of the green energy uses a lot of silver, and the infrastructure for AI uses a lot of silver. So um, the demand for silver is only going to increase over time. And it takes time to expand mining production and find more silver. So there's going to be a lag. So I suspect the deficit's going to continue for a number of years before we could catch up. And that I think that's going to be at least a significant driver to the price of silver, but I'm sure the main driver is um, just the expansion of the money supply, and silver just follows gold. And then when you get in late in these cycles or in the final months of a bubble phase, then gold is very expensive, and so people start looking for something that's a little cheaper. Gold's $10,000 an ounce. Well, I can, maybe I can buy 1 or 2 ounces, but hey, I can buy maybe 80 ounces of silver. So I'm going to start buying silver. And it doesn't take much liquidity going into a very thin silver market to, and I've said this before, we're getting close to 50. I think we could probably maybe it takes another year to get to 100. Maybe even takes a year and a half to get to 100 after we get through 50. But it could literally go from 100 to 500 in the last 6 to 8 months of the bull market, because that's just how silver moves. When that liquidity starts to flow in there, you just get some crazy upside moves in a very short period of time, which also makes silver dangerous. At some point in that parabolic move, you gotta control greed and sell, because it not only does it go straight up, when the top comes, it goes straight down.
Mm. Yeah, no, definitely. I'm almost looking forward to that, but having to remember that you've got to be smart about your exit strategy. Talking of which, I know that people have different thoughts and opinions on this. Some people are looking at the gold and silver ratio, saying, when that gets to this certain level, that's where I'm looking to get out or convert to gold, whatever it might be. I'm not going to ask you to necessarily share your exit strategy, Gary, but what sort of things would you be looking at in terms of the very longer picture after 2029, so to speak?
So there are multiple things, but the one you mentioned, the gold silver ratio, is a very good one. Um, I think the last bull market, I want to say the gold silver ratio got down to 30 to 1, 30 ounces of silver to 1 ounce of gold. I would say that's also a pretty good signal for this bull market. When the gold silver ratio, when silver starts to go crazy to the upside and that ratio comes back down to 30, and it might even get as low as 20 to 1. But once we're down to 35 or 30 to 1, you probably want to think that you're on borrowed time, and it's probably time to start selling your metals, because I know a lot of people say, well, I'm never going to sell my gold or silver, but I'm not in that camp. Everything gets overvalued at some point, and there's going to come a point where gold and silver is overvalued, and you need to sell it and go find something that's undervalued. I don't know what that's going to be right now. Maybe stocks will be in a big bear market from a recession or depression, and it'll be time to they'll be very undervalued. Probably the dollar will be very undervalued at that point, and when gold and silver is when that ratio goes to the 30 or 20 to 1, whatever. And maybe it's time to trade in your gold and silver for dollars. Um, but there will come a point where gold and silver is overvalued, and then you need to try and find something that's undervalued and switch your investments.
And we also, I guess, don't know what sort of world we might be in 4 or 5 years' time, given things that you alluded to earlier on with movement of war machines and so forth. Gary, in terms of exit strategies, just quickly going back to that. So really, it's a case of wait and see. But if someone was wanting at that point exposure to precious metals, still wanted it, would it make sense for people to possibly swap a little bit of gold, a little bit of silver into a little bit of gold just to maintain a bit of exposure in the long run, uh, or is that
Um,
not necessarily viable?
well, if that's your mindset and you're just dead set that you're not going to sell your gold, keep in mind that it took what 40 years for the well, not for gold, but it could take 20 to 25 years before the next bull market could recover back to those highs. So you may have to wait a long time. But if we're at that top and you want to switch out your silver for gold, you're going to lose less percentage wise in
Mhm.
gold during a bear market than you would in silver. So silver will have that huge parabolic move. It'll also have a major crash. Gold will crash too, but silver could lose 80 or 90%, whereas gold may only lose 50 or 60%. So you'll lose less by switching from silver to gold if that's your mindset, that you just are not going to sell and you'll ride out the bear market, or you don't believe that there will be a bear market.
We'll see what happens in the next few years for sure. One last thing, Gary, because I know that obviously you're well known for gold and silver, but I do know that you keep your eyes on a couple of other markets and in major indices and so forth. So what else are you seeing at the moment with what you keep your eyes on?
So the stock market is clearly in a runaway move to the upside. I'm not interested in playing that though, because there's just a lot more money to be made in the metals, which are also in a strong bull move. But stocks are in a runaway move. The downside to a runaway move is that they tend to crash when the top comes, and trying to pick that top is basically impossible. So you get these mild little corrections that they're all roughly the same magnitude, and this one appears to be, in the S&P anyway, somewhere between 150 and 200 points, and then it'll run again. And at some point, you'll get another one of these mild little corrections, and that'll just go and go and go until it doesn't. And then when it doesn't, you can literally wipe out 4 months of gains in 1 or 2 days. You could even wipe out 4 months of gains literally in a matter of, minutes or an hour or two. So that's the danger of these runaway moves. They condition people to expect only these little mild pullbacks, and then you got to buy the dip, and then at some point the dip fails and you have some kind of a big crash event. But I'm like I said, I'm not in the camp that the stock market's in a bubble. It's not in a bubble. AI is still fairly young still. So, but for right now anyway, stocks are in a runaway move. The danger is that you get caught when the crash comes at the end. Bitcoin looks to me like it's probably in an intermediate degree correction, because it's made a lower low, and apparently it looks like it's also made a lower high. So that probably has another several weeks, maybe a month or two to run before I think Bitcoin would be set up for another intermediate rally. And it also, we may be in the timing band for a 4-year cycle low in Bitcoin, so it may be a lot more destructive move than just an intermediate degree correction. So I'm not terribly interested in Bitcoin. Energy also looks like it's in an intermediate decline, and it's in at least a cyclical bear market, because it's making lower lows and lower highs of intermediate degree. It's kind of forming this support zone at about, I'm taking a guess here, I think it's about 61.50-ish, something like that maybe. When that support zone breaks, you could get what I call a bloodbath phase, which is 5 to 7 days of just panic selling day after day after day. That could go down and test that low. And I don't remember offhand where that was, but it's probably down around 55, something like that. Uranium looks, I was expecting maybe a longer sideways churn in the uranium stocks, but they broke out pretty quickly. It seems pretty obvious that the market is saying that wind and solar is not going to be the clean energy of the future. It's undependable, and it's just it's not economical without subsidies. And so the market I think has clearly recognized that, and it's recognized the obvious, that if you want some kind of energy that doesn't produce carbon dioxide, which in my opinion is, we're not destroying the environment with carbon dioxide. The food chain has to start, everything is made of carbon, so it has to, with the carbon has to come from somewhere. The plants use carbon to, for the first stage of the food cycle. But anyway, I think the market has recognized that nuclear is the way to go. That if you're really worried about a little bit of carbon dioxide, that if you want to try and lessen that impact, it's going to be nuclear. So I think nuclear is probably, um, it's going to be in a bull market for a long time. It's just that I'm not that familiar with the uranium market. Not sure that it's a large enough market to have dependable cycles. So I'm not really focused on uranium like I am metals. Maybe I will get more focused on that if I think the bull market in precious metals has come to an end. But for right now, I'm just going to focus on the metals, which is a market I'm familiar with. But I do think uranium is in a secular bull market as well.
Yeah, and there are, as you just mentioned there, the growing energy trend and all the news that we're seeing, I think helps to facilitate that. We'll see what happens moving forward. I certainly agree with you there. Gary, it's been a wonderful conversation. Before I let you tell people how they can find you, is there anything else we haven't spoken about today in any markets at all? Is there anything we haven't spoken about that you would like to bring to people's attention?
I think we covered everything that all the markets that I'm familiar with. And, I'm sure there's other markets, but they're not, my expertise. So I don't get into markets that I'm not familiar with.
Perfect. Right. I'll take that as a sign if I've done a good job, if I've asked all the right questions. Then, how do people find you? How do people connect with you, get in touch with you?
Well, they can follow me on X. My X handle or whatever it's called is Gary Savage one, the number one, in lowercase g. Um, the SMT is closed for new subscribers right now. I only do yearly subscriptions. I will reopen in December for new subscribers. And I plan to continue the SMT for as long as the bull market in gold and silver is in progress. And we're still in the advancing phase of this 8-year cycle. So, and we still have a breakout from this 13-year cup and handle pattern. So we're making a lot of money every year, and basically just focusing on gold and silver. And usually you get two of these intermediate cycle bottoms. So what I try and do is we try and get leveraged at an intermediate cycle bottom, ride that to pretty close to the intermediate top, get out, wait for the next one. I don't get sidetracked into other markets when when gold is correcting or going sideways or whatever. We more or less we just kind of twiddle our thumbs and wait. So
Mhm.
be aware that that's if you're going to sign up in December, that's what you're signing on to, that there's going to be periods where we just don't do much. But because we are in big bull markets, we're making a lot of money. We had a record year last year because of the breakout in gold and silver, and this year we've blown those returns away. And I think we'll do it again next year and maybe the year after, and then at some point here we'll have to start looking for a final top in the gold and silver bull market. But December, I'll post it to X when I'm ready to open up the SMT for new subscribers, but it won't be until December.
I'll put a link in the show notes just so people can have a quick look. But I would urge people definitely to follow you on X if they don't already do so. Gary, wonderful. Thank you for your time again. It's been fantastic to catch up. I look forward to catching up in 2026.
Thanks for the invite again, Robert.